What's going on, everyone? Welcome to another video lesson. Today we are going to be talking about the futures market. But before we dive into the PowerPoint, I wanted to show you that I have a blog post already written about the futures market. You can use the blog as a quick reference if you forget anything in these videos. Please understand that the blog post probably has many grammatical errors, and if you find any, please let me know so I may adjust them. The general outline for this video is: what are futures? Similarities and differences between futures and equities. What is margins in the futures market? What is maintenance margin in the futures market? How to calculate the risk reward when you buy and sell a futures contract. For this, we will be using the TradeStation website and danielstrading.com futures calculator to illustrate these points. And last but certainly not least, we will be talking about the advantages of trading futures over equities. All right, so what is a futures market? And the futures market is an auction market in which participants buy and sell commodities and futures contracts for delivery on a specified future date. Futures are exchange traded derivatives that lock in future delivery of a commodity or security at a price set today. So as I stated in one of my earlier YouTube videos, the marketing around equities is much greater than the marketing around futures. Thus, explaining futures to people who are unfamiliar with them through the lens of equities helps most people understand them better. For the most part, trading futures is just like trading equities, except for a couple key differences. Unlike the equity market that trades in shares, the future market trades in contracts. Futures contracts fluctuate in price just like shares of a stock. The reason for changes in price are the same principles of stock trading. As market conditions change, the future expected value of the underlying security changes and the price of the contracts adjust accordingly. For instance, oil futures contracts are very popular. A 30-day contract may have a price of $100 per barrel, meaning the buyer is locking in his purchase price in 30 days at $100 per barrel. If the price of oil in 30 days is actually $110, the buyer still only paid $100. He now owns an asset worth more at the current market value than the price he paid. As the price of the oil is rising, obviously the contract will not continue to trade at the same value, and the owner can either choose to hold the contract until expiration or sell for a profit on the secondary market. A key fundamental difference between an equity security and a futures contract is the way in which the market determines price. An equity security is always priced on what the market believes it is worth today. A futures contract will always be priced based on what the market expects it to be worth in the future at expiration. If an asset is spot trading at some price, while rare, it is possible that the market will expect a lower price in the future, and the futures contract price will imply a lower future expected value. Now that we have a basic understanding of what the futures market is and how it is similar and different from the equities market, we need to go over the requirement of buying and selling a futures contract. The first step to buying and selling anything is to understand how much one has to put up in order to do this transaction. That is where one must understand leverage and margin in the futures market context. The best way to describe leverage in the futures market is to understand it from the lens of buying a house. When someone is a first-time home buyer, they generally must take out a loan to purchase their house. However, they are required to put down some amount of money up front to secure the loan. Generally speaking, this is 20%. Therefore, you could say that in order to control a $200,000 house, you need to put up $40,000 initially. Similar to leverage in our house example, when traders buy a futures contract, traders control a sizable amount of the underlying cash asset. This could be in an index future, currency, or physical commodity for a small deposit referred to as a performance bond or contract. This contract acts as collateral for controlling the asset. So to control the asset, this is known as initial margin in the futures world. So in a typical futures contract, the margin rate varies between 3% and 12% of the total contract value. So for example, the buyer of a contract of wheat futures might only have to post $1,700 in margin, even though the asset that they're actually controlling is worth $32,500. And thus we could say that if we posted $1,700 to gain that contract, that would only be 5% of the $32,500, which is the total asset value. Initial futures margin is the amount of money that is required to open a buy or sell position on a futures contract. Initial margin is the original margin and the amount posted when the original trade takes place. The other thing you have to be aware of is maintenance margin. And maintenance margin is the amount of money necessary when a loss on a futures position requires you to allocate more funds to return the margin to the initial or original margin level. For example, say the margin on a corn futures contract is $1,000 and the maintenance margin is $700. The purchase of a corn futures contract requires $1,000 in initial margin. If the price of the corn drops 7 cents or $350, an additional $350 in margin must be posted to bring the level back to the initial level. Margin calls are triggered when the value of an account drops below the maintenance level. The futures market is a cash business. Everything must be settled at the end of the day. If you are in the negative and you can't pay your debts to the broker, they actually have claim to your assets like your house, your car, your computers, really anything that they want. A great depiction of this is in the movie Trading Places.
Margin call, gentlemen. Oh, you can't expect us to...
You know the rules of the exchange, Mr. Duke. All accounts to be settled at the end of the day's trading, without exception.
You know perfectly well we don't have $394 million in cash.
I'm sorry, boys. Put the Duke Brothers seats on the exchange up for sale at once. Seize all assets of Duke and Duke Commodities Brokers, as well as all personal holdings of Randolph and Mortimer Duke.
My God. We're ruined.
This is an outrage. I demand an investigation. You can't sell our seats. A Duke has been sitting on this exchange since it was founded. We founded this exchange. It's ours. It belongs to us.
My God.
Mortimer, your brother's not well. We better call an ambulance.
Fuck him. Now you listen to me. I want trading reopened right now. Get those brokers back in here. Turn those machines back on. Turn those machines back on.
So you're probably wondering, well, how do they come up with the initial margin and the maintenance margin calculation? And that is through something called SPAN. This is a program that measures many variables to arrive at a final number for initial and maintenance margin in each futures market. The most critical variable is the volatility in each futures market. The exchanges adjust their margin requirements based on market conditions. Alright, so here's the wrap up on margin. Margin is a good faith deposit that the market participant posts with the exchange or clearinghouse. Think of margin as a down payment on the full value of the contract that you are trading. Margin allows the exchange to become the buyer for every seller and the seller for every buyer of a futures contract. This has two benefits for market participants like you and me. It guarantees anonymity. The exchange is always your counterparty, and it eliminates counterparty credit risk from the transaction. Exchanges are regulated by the Commodity Futures Trading Commission, or the CFTC, and have plenty of funds on hand to meet all obligations. Those funds come from the margin collected by market participants. Since margin is only a small percentage of the total futures contract value, there is a tremendous amount of leverage in the futures market. Now, if you want to know how much maintenance margin / margin you need to put up to control an asset, you can either go to the official government website or your broker's website. My broker is TradeStation, so in this next example, I took a screenshot of the margin requirements for some futures contracts. So here at the bottom, we have the E-mini S&P 500, which is an index futures contract, mid-cap, NASDAQ, and Russell. So if I wanted to buy or sell one E-mini S&P 500 futures contract, I would need to put up $12,100, and my maintenance margin would be $11,000. Now, you see something that says day trading rate. Some brokers allow this, some don't. And TradeStation in the past, when things have become more and more volatile, take away this day trading rate. And that is to allegedly keep traders safe. It's total bullshit. in my opinion, but they can do that. All right. Just like they can increase the margin rate when things get too volatile for them. And you either at that moment in time have to put in more money if your account can't cover that contract, or you'll be liquidated, or hopefully you're smart enough to have enough funds already in your account. All right, so once we understand what margin is, we have to now understand how do we calculate the value of that contract. Margin is not the value of the contract. Margin is what you have to put up to hold the contracts. One website I recommend to all new traders who are getting into futures is danielstrading.com because of this table right here. So for the E-mini S&P 500, you see where it says contract size. It says 50 times the index value. And then you see where it says minimum tick fluctuation in value. It says 0.25 and $12.50. This tells me that when I look at the E-mini S&P 500 or ES, so in TradeStation it's at ES to pull up the data, it's going to be fluctuating in 0.25 increments. So it's going to have 2000, 2000, 0.25, or it could be, 1999.75 on the opposite end. And every 0.25 move is worth $12.50. So we could say 1 point equals $50. And this table also tells me delivery months, which has to do with contract rollover, and the delivery month symbol key, which tells me if I see ESU 21, which is the front month contract that we're currently trading, that this U corresponds to September. And we'll get into contract rollover here in a second. But danielstrading.com, definitely helpful, giving you all the information you need to do the calculation to understand your risk, because if you buy at 2000, your maintenance margin that you have to put up and margin you have to put up is here to hold the contract. The value of the up and down movement of your profit and loss value is determined by this either moving for you or against you. So if the market goes to 2001 and you sell, you made $50 before commission and fees, and this $12,100 would go back into your account at the end of the day. So hopefully that makes sense. And if you are ever unclear, like, I don't remember the value of, let's say, the micro contract, you see how I just clicked it and it tells you this is what it's worth. You can also enter in prices and a number of contracts that you're trading, and it will tell you your profit and loss as well. Very, very handy website for futures traders because everything is all in one location. Now, let's talk about contract rollover. Unfortunately, there is no mnemonic device I can give you to make you remember this. Over time, you just need to remember at least contract rollover symbol keys and the minimum tick fluctuation of the commodity or index you're trading. That will just come with, constantly trading it, constantly looking at it. So when we look at delivery months, we see that for the micro E-mini and all of the index futures, we see HMUZ. And what that tells me is that every 3 months, the contract rolls into the next contract month. You cannot trade just ES. Every time you trade, you have to have the contract month associated with it. Currently, we're on at ESU 21. And in 3 months from now, I will need to be trading at ESZ 21. When we say we're trading the top step contract, that means we're trading the current contract month. We're not going out into the future and trading, ESU 22, but we could technically. I'm always trading the top step contract. Most of you will always be trading the top step contract. And in TradeStation, for example, it tells you in a watermark what is the top step contract, and therefore all you have to do is just type in the symbol. You can also find this online as well and through government websites, but most likely your broker will tell you in some fashion. All right, last but certainly not least is what is the advantages of the futures markets versus the equity markets? So in the equity world, you are required to have $25,000 or more to get around what is known as the pattern day trading rule, which limits how many trades you can take in a given week. In the futures world, this rule does not exist. So for all of you who are quote unquote day traders, because that is what you want to do with your life, you really should not be so addicted to equities if you have under $25,000. Also, in the equities market, if you want to short a penny stock, you usually have to find a special broker or even some bigger stocks sometimes. Unlike that, in the futures world, it's easy to go long long and short, because remember, who is our counterparty? It's the exchange. Also, when you short stocks that are hard to borrow and you're using a special broker, they will charge you outrageous fees if you try to hold short overnight. Also, in the equities world, the market is only open from 9:30 a.m. to 4 p.m. Eastern Standard Time. So if you are long or short overnight, you can't get out of your position. Think about that. Something happens overnight, you're stuck. Most index futures and commodities are open 23 hours a day. Most of them open on Sunday at 6 p.m. Eastern Standard Time and go till Friday at 5 p.m. Eastern Standard Time. And the advantage of this is you can get out of a position at any time or put a stop in and get out. Depending on what you want to do with your life and how you want to go about trading, you seriously need to consider this table that I made for the pros and cons between the futures market and equities and generally penny stocks for whatever you're trying to do. So that's going to do it for me. If you guys have any questions, comments, or concerns, or maybe I forgot about something, please leave it in the comment section below. Thank you for watching, and I'll catch you in the next video. Peace. What's going on, everyone? Thank you for watching this video. If you like this video, please click subscribe and hit the bell notification. Remember, it's not enough just to subscribe anymore. For some fangled reason, YouTube makes you click 2 buttons. That's not my fault, okay? So you have to click subscribe, and then if you want to get notified on new videos, you have to turn on the bell notification.